Welcome to Market Mindset Monday, where we break down the psychology of smart trading. Because before you master the market, you need to master yourself. Hi, I'm George, your teacher in our channel Stock Trader School, from Rookie to Rainmaker. And in today's episode, we are going to talk about one great trade doesn't make you invincible. In fact, it might just be the start of your downfall. So let's see how many of you can relate to this. We've all been there. A market entry, perfectly executed, flawlessly managed, an absolute home run. As the trade unfolds, everything aligns like a well-oiled machine. Welcome to the jungle of market psychology, where every trader navigates their own internal battles. One of these silent, sneaky saboteurs is overconfidence bias. That single winning trade fuels a fire within you, a fire of confidence, maybe even arrogance. Analysis becomes a quick glance instead of a deep dive. Research shows that this cognitive bias often leads to poor decision-making. When you skip the due diligence process, you miss crucial details that could have signaled potential pitfalls. One great trade doesn't make you invincible. In fact, it might just be the start of your downfall. This sets you up for disappointment because each trade is unique and expecting the same outcome can lead to frustration and potentially more losses. You might ignore market indicators or technical patterns suggesting a potential reversal because your belief in your own skill set prevents you from acknowledging the possibility of a mistake. Your analysis, your plan, the execution. You hit that take profit button and whoa, baby, what a feeling. That green candle still fresh in your mind, your heart does a victory dance. Create a pause button in your trading routine. After a significant win, don't immediately jump into the next trade. Take some time to step back, reflect, and detach from the emotional high of the previous win. This could be a fellow trader, a mentor, or even a trading coach. Having someone to review your trades and provide honest feedback is invaluable. They can spot overconfidence or other biases creeping into your decision-making and provide guidance to help you stay on track. This break allows you to maintain objectivity and prevent impulsive decisions. Recognize the power of overconfidence, but also acknowledge your other emotions. Fear, greed, excitement, they all play a part in the intricate game of trading psychology. But it's your ability to understand, manage, and adapt to these emotions that truly makes the difference. After a win, your brain releases dopamine, a neurotransmitter associated with pleasure and reward. Develop a checklist of key points to review after a winning trade. This checklist should include things like reviewing your analysis, noting areas for improvement, and most importantly, ensuring your next trade is not based solely on the previous win. By creating this buffer between a winning trade and your subsequent actions, you can reduce the influence of overconfidence. This is your brain's way of saying, hey, you did great, do it again, but that's where the trap lies. Your brain wants you to repeat that action, ideally on a larger scale. Some platforms offer built-in alerts or suggestions that can remind you to follow your strategy, stick to your position size, or review your analysis. You can also find apps or extensions that specifically target overconfidence bias, providing prompts and checks to keep you on track. Let's explore some strategies to keep overconfidence in check. Here's a simple checklist you can use after every winning trade. After all, if one good trade was good, then 10 good trades must be great, right? Wrong. It's a simple yet powerful tool designed to help you stay focused and objective after a winning trade. Remember, one great trade doesn't make you invincible, but with the right mindset and tools, you can ensure that every trade, whether a win or a loss, contributes to your long-term success. Don't let your emotions dictate how much you invest in a trade. Whether you're reusing a fixed percentage of your total portfolio or following a specific rule for profit targets, stick to it. Avoid the urge to increase your position size just because you had a winning trade. Remember, each trade is independent and past performance is no guarantee of future success. Picture this: you successfully navigate a tricky trade, your confidence soars. This cognitive bias causes you to overestimate your ability to have predicted the outcome of a trade. You might think, I saw the setup, I recognized the pattern, I knew it was gonna go my way. This illusion of control can further boost your confidence to dangerous levels. But here's the kicker: it makes you overestimate your skills, leading to oversized positions, skipping critical analysis, and expecting the next trade to mirror the last. You start to believe your own hype and that S when the next trade comes along and whips you back to reality. You fist pump, you high-five your screen. But wait a minute, the next trade. You want that same magic, that rush. Maybe you increase your position sizes beyond what your strategy or risk management plan allows. Or perhaps you disregard your stop losses in pursuit of bigger profits. This impulsive behavior driven by inflated confidence can lead to devastating losses. But it's not a home run, is it? And now the weight of that expectation hangs heavy. We've all been there. Now, here's where the problem begins. So why is it that one winning trade can send you spiraling into a series of losses? So what is overconfidence bias? Overconfidence bias is that subtle, often unnoticed force that tricks traders into thinking they're better than they really are. So how does overconfidence look like? Overconfidence shows up in a variety of ways. Let's first consider overly aggressive trading. This is when you start taking unnecessary risks. Then there's cutting corners. Next is chasing unrealistic expectations. After that exhilarating win, you might start chasing the same level of success in every trade. Finally, ignoring warning signs. Overconfidence can make you blind to warning signs. But why does overconfidence happen? Understanding the psychology behind overconfidence is key to tackling this bias. Our brains are wired for quick dopamine hits. Another factor is hindsight bias, also known as the knew it all along effect. Now, can you relate to any of these points? How has overconfidence affected your trading journey? Let us know in the comments below. So how do you control overconfidence? Once you recognize the signs, it's time to take action. First, implement fixed rules for position sizing. Next, force a cool-off period after big wins. Third, check your checklist. Fourth, seek external feedback. It's helpful to have an objective third party assess your trading. Fifth, use technology to your advantage. There are tools available that can help traders identify and manage cognitive biases, including overconfidence. Remember, it's not about being overly cautious or hesitant. It's about maintaining a clear, rational approach to trading. So are you ready to take charge of your trading journey? As you navigate the world of trading, always remember that self-awareness is your greatest ally. Like today's mindset breakdown. Drop a like, and don't forget your biggest edge is your emotional discipline. Trade calm. See you next Monday.